Is Icahn Enterprises the new Madoff? And how bad is it with the banking sector, Martin? Can you start please with this?
Yes, I think everybody that follows the financial news knows what's going on in America. We're going to talk about the American banking sector. We did it a couple of weeks ago, but it's so hot we can't. This is a financial vlog. We have to talk about that. First of all, on Wednesday, I was looking at the speech with Fed President Powell. And it surprised me that when he started his speech, he said the first thing before I start, I want to generate some tranquility. The banking sector is in a much better place than it was in March when we had the previous meeting from the Fed and the previous interest rate hike. And not even 24 hours later, there were two banks again in trouble, and there was the PacWest and this Western Alliance, and the trading was stopped of those two funds. So I don't know if it's going so much better. I mean, they're obviously small players, but if you look at for instance, PacWest, they had a market cap of 3 billion at this moment. Before it was approximately 15 billion. So it's if you look at ING in the Netherlands, it's 38 billion. So a market cap of ING. So the regional U.S. banks are not by default of also small banks. They're pretty big, and they are at this moment. If you look at those banks together as a package, there's actually an index made out of those companies, out of those banks. It's the S&P 500 Regional Bank Select Industry Index, and that index is approximately 85% under the highest levels, and we're almost at a pandemic level of those banks. Basically, they have dropped dramatically, and that's of course due to Western Alliance, PacWest. Those stocks have dropped 85%. So what is going on? The market is just really worried about the future of the American banking system, and that's logical because as Kaspar also explained to us a couple of weeks ago, there is a big problem with there's a credit risk. There's a big risk for a run on deposits, so people take their money out. Just very simple. If you have a saving account at Silicon Valley Bank, well, obviously not anymore, or at PacWest, and you have 200,000 or 300,000 there, but you also at the same time have an account at Morgan Stanley or Goldman Sachs, why would you take the risk? It's within 2 minutes you transfer your money to a safer bank, and if that happens one time, it's not a problem, but if that happens 500,000 times, and all these clients are starting to take out their deposits, transferring it to other banks, then you will see a big problem. And what the market in general thinks, because that of course regulation, the credit risk, and the high interest can cause a catapult, basically, that the rest of the stock, so the normal stock market, to say so, the tech companies and the oil companies, and that basically you get a general sell-off because a lack of confidence. That's what the Wall Street, to call them like that, is thinking about. The risk for this moment, so that there's a confidence issue coming up, which will cause the market to go down. Now, well, that's what they think. Pretty negative story.
And Powell and also the ECB this week helped the market to become even a little bit worse than it was before by raising interest rates, because what you said, a big problem is the value that they have in AAA and other really secure investments. And by raising the interest rates, the value of those are going down even a little bit more.
Exactly, and the thing is, they did not mention anything about that. The only thing what Powell was mentioning was about the extremely excess in supply on the labor market. So there's so much people still, companies offering jobs, and there's people can get very easy access to jobs, and the inflation needs to come down to 2%. That's
his goal.
That's his goal, and that's the only thing that he's worried about. If he can conceive that,
main thing,
no, but it's really because, and what I told you also before, what surprised me, because I said, how was this then in 2008? Are these guys then not worried when stock markets are dropping 60%? Well, I looked at Bernanke at the time. He was just giving, we see this and this and that. They're pretty. I mean, of course, it would be a bad thing if they're worried as private investors, of course, and they start doing crazy
giving
stuff.
A presentation and
the sweat is dropping here, and he's looking at his phone at his stocks. But it's not like that is the main goal, to keep the stock market high. So always be aware of that. To finish off with, there's an ETF, the iShares Dow Jones US Regional Bank Index. Of course, not all the regional banks will go bust. There will also be companies that are willing to, or are capable to stay alive. That index, that ETF had a quotation in February of 55. At the moment, you can buy it at 28, so it dropped almost half. And you can still go either long or short in that. If you want to go short, you have to do it with a alternative product. In this case, a contract for difference. Be aware if you want to do that, because it's a little bit more difficult. Also, more risk involved. You obviously trade with leverage. But you have a look at it. That is basically the main problem in the US. It's the regional banking sector.
But there's another problem in the US.
Another problem.
Icahn Enterprises.
And Icahn Enterprises, yeah.
Is that the new
Carl
Madoff?
Icahn.
Is that the new Madoff? If you see it, and probably our editors will put a picture in the screen, then you say, oh yeah, of course, that's him. If you not already knew.
To say Madoff did a really bad thing. I don't think Carl is doing this.
I'm asking a question.
I mean, if you look at the documentary on Netflix about Madoff.
There's also a documentary about Carl on Netflix, by the way.
Yeah, actually it's true, yeah.
Okay, what's happening?
Tell us what's going on.
First of all, because with his son Brett, they have a closed-end fund, what I just mentioned. So it's traded on the stock market. Mm-hmm. It had a value on Labor Day, the 1st of May, of $18 billion. Then on the 2nd of May, there came a report out by the Hindenburg Research Group, and that's a really well valued company. And what they said they draw the conclusion that it's overvalued and it's a Ponzi-like business, and that's something to say, of course. Now, how did the market respond on that? Maybe you saw it. In 2018, it was still trading at around $80. On the 1st of May, it was trading at $50, and on Thursday, so in 3 days, it dropped from $50 to $30. So it lost 40%. So the value also dropped from $18 to $10. So almost $8 vanished. $8 billion vanished. Okay. I want to highlight 7 points out of the report because we read it that will prove their conclusions, and then you can draw your own conclusion, of course. If you say, okay, I want to buy it or I want to sell it. First of all, I have to say that the Hindenburg Research Group, they have a short position in it, and that's also how Carl responded this week in the news. Yeah, but they put it, they make this report because they have a short position in it. So that's the only response that he gave publicly. 7 points I want to highlight out of this report. First of all, they say that the value is 280% higher than the net asset value. They compared this closed-end fund, with 526 other funds. And the second one with a high traded value was another group, but they traded 100% higher. So number 280? 218% higher the value. How it's valuated is 280% higher than the real value. And number 2 out of that comparison of 526 funds traded 100% higher.
Wow.
That's already something, of course.
It's quite something, yes, definitely.
If you look at the portfolio of them since 2014, they lost 53%. If you compare that with the S&P 500, it gained in that same period 150%. In that same period, so since 2014, they had a negative cash flow of almost 5 billion. They paid out in the same period 1.5 billion in dividends. So you can say that's what they stated. They use money from new investors to pay out that dividend, and you are then going in a direction of a Ponzi scheme, because you take money from the other ones and pay it out in dividend.
Exactly, if you do it like that.
Yeah, that were already 4 points if you calculated with me. 2 valuation examples. For example, Fiskcase at the end year reports of Carl. They had it valued of 243 million, but it was the only real value, because it's also public traded, is 88 million. And then they have the automotive part division that was traded. It was valued at $381 million, but that has gone bankrupt, so that is now zero.
Yeah, so they still need to write that off.
Yeah, so the 218% is quite, they gave more examples, is quite reasonable. In 2020, UBS stopped with governing them, and they gave already back then, so that's really good of UBS, a sell advice on the fund, because they say it's overvalued and it's not transparent anymore. That were one of the two large banks that helped them, UBS. Only Jefferies stayed, but that's an old friend. You can read it. It's an old friend of Carl Icahn. Last thing I want to mention, since 2015, they were not able to go into more in new debts. They only can refinance their old debts. They have a total debt of 7 billion against 2 point something of billion in cash and short-term investments. So again, the value on the stock market is on Thursday evening 10 billion, dropped from 18 till 10, and the total debt is 7 billion. So it's getting risky. And out of those debt they have is 60% margin loans, and that's a really risky business to finance your business.
It would be really something if this guy, I mean, he's 84, right?
Something like that.
He has a really good reputation.
Definitely.
It would be really sad if it goes wrong.
Definitely, it's not good for the market. It's not good for.
No, but also all his life, and now he's at the end. I'm wondering how he would deal with this. How he would be waking up in the morning and say it was. I mean.
I think that he, of course, the news, what the things that are written down, he is aware of that.
Yeah.
You can't be not aware of it if it's your fund and you are with almost all your money in it.
Of course. But these figures as well, if it's 10 billion value, 7 billion of debt, with 60% margin loans, that is really risky.
It's extremely risky.
Yeah, that's what I'm saying. So I mean, would you then playing like Russian roulette or something? Like it's all or nothing.
I think so. A lot of leverage, sustainable losses. And used and still wanted to pay out the dividend with new money. So be aware. Use this information.
Absolutely.
Go long, go short. Don't do anything. There are three possibilities.
Yeah.
So today, unfortunately, not that positive news, but we want to bring you something. Hopefully, you didn't know, so that helps you with your investment. We're not here to say this is fantastic. An iPhone sold even more, of Apple even sold more iPhones.
Yeah.
You can read it in the newspapers. This you can also in the newspaper. But we want to give you something extra. But although we gave you not a really positive news, please give us your thumb. Okay, see you next week.